How are we doing, guys? Welcome back to the course. In this video, we're going to be talking about risk management and technical analysis. So we've spoken about risk management quite a lot, and you know that we need to always be using risk management inside of our trading if we want to succeed long term. We know that not every trade we take is going to win. We are going to encounter losses, and regularly as well. So we need to be able to overcome those losses when they do show. So we've spoken about risk reward ratios mostly. That is the main part of technical analysis and risk management that we're going to need to do. Okay. The risk management loan aspects include position sizing and always using a stop loss. And then when we come to incorporating it all into our technicals, we want to make sure we are trading with a 1 to 2 or higher risk reward ratio. Okay. So for example, we never want to be aiming for a trade smaller than this. And now what this means is if this trade wins, we will win twice of our risk, right? So if we risk $100 in every trade, this trade is going to win us $200. So then that means we can then have another loss and we'll still be up $100 in profit, okay? We want to aim for the highest risk reward possible without being unrealistic, because making your risk reward too tight can end up having illogical stop losses, okay? People will end up using illogical stop losses like this one, too small, things like that, hoping for huge risk reward, saying, okay, this is 7.75 risk reward, so I can win this, and then I could lose 6 trades, and I would still be up $175. But the problem is, with a illogical or unrealistic location for your stop loss, chances are it's going to get hit, and then you're actually just going to end up taking, 7 losses for every 1 loss that you would have taken if you used a logical stop loss positioning using zones and highs and lows in the market. So risk reward, we know that we need to always be going for a 1 to 2 or higher. We're not always going to achieve 1 to 2. Some trades are not going to end out that nicely for us. Some trades will have to cut early, and some trades, are going to find resistance or find support in areas that we don't want them to, and we're either going to have to early close or they're going to close themselves using the stop loss in profit or stop loss at break even. So that's pretty much the main thing I want to talk about in this video, is that use of stop losses inside profit or at the break even point, so that when you take a trade, you can actually go ahead and remove the risk from the trade when possible. And then if the trade goes south, the trade goes sour, and you end up hitting a loss as such, you won't hit a loss. It will close the trade out at break even, and you'll still be fine with all of your capital to go at the next trade. So we're going to talk about that in this video, and I'm going to show you some live execution examples. So here we have a hypothetical example on GBP JPY. We're on the hourly chart, and basically it's not the greatest structure break, but for the example's sake, we can see uptrending market. Okay, we form a high point up here around 134.750, and then we form this structure low point, which is taken out, right, along with some consistent lower highs. So we could be seeing this lower high as an area of reversal. And if we actually use our additional confluences that we've spoken about, we can see that this is a key level, and we do kind of have this buy to sell supply zone type movement. So let's say then, for example's sake, that this was a nice trade setup that we were going to take. We've seen this inside bar break out, okay, tapping into that level and then breaking out. So this then indicates the trigger for our trade. So we're going to go ahead and sell the inside bar retest around here, and we'll put a stop loss above the high. And for this example, let's say we are going to go and target this next low point, 131.750. There we go. That is what we're going for on this position. So we have a nice 4.8 risk reward move planned, as long as this thing runs in our favor. So if we then allow the market to actually play for a bit, we can see the trade starts off very nicely. And it's around this point we would actually think about removing the risk from our trade. Okay, and what we actually mean by this is moving the stop loss, grabbing our stop loss order, which is at the moment positioned up here at 134.1, and bringing it down to this point around 133.7, just at that profit point, just at that area where we entered the trade. Okay, so our stop loss is now here. And what that means is we are completely risk-free on a movement. So if this trade actually goes sour and turns around on us, we're not going to take a loss. Okay, that $100 we'll use in this example loss is no longer going to be a $100 loss. We're either going to win that 4.83 risk reward or that $483 movement, or we are going to get closed out at no loss. Okay, so if we allow the market to play, we have a nice confident looking movement. Sharp reaction there. Look at that sharp reaction. And big takeout to the upside. So that would have taken out the stop loss, but because we know how to manage our trades now, and because we know to move our stop loss into that break-even point, we will have completely avoided taking that loss right there, okay? So that is actually how we're going to use stop losses to remove risk, how we can really utilize stop losses further than just cutting out losses, actually to completely avoid them altogether. Now, what we can really do then is allow the market to do its thing and find a new opportunity in line with the trend or from a higher selling point. Now, it's frustrating, of course. This movement would have been a $290 movement at its peak, and it's frustrating to let go of $290 in unrealized profits. But what's more frustrating is losing $100 of your own money. Okay, so as we know, trading is all process based, and we always want to make sure when we are trading that we are cutting risk as soon as possible, as soon as logically possible. Now, it's important that we don't cut risk too fast, because if we do that, we will actually end up just stop here on a load of trades. Because the thing is, trades move quite sideways. Okay, so let's say you sold from here, and the market only got down to here, and then you break even the trade. Now, this spike would have taken you out before that little movement lower. And I know in this example, this isn't the best because we do actually reverse. But as you can see, if you were selling from the peak up here, for example, this trade, if you were selling from the peak right up here, and you didn't allow the market to get far enough and take a structured low point or form consolidation and break it, something like that, then what would have happened is you'd have been sitting for a long time in profit just for this one single wick to take you out the trade before the actual structure low gave way and before the bigger movement came through. So we need to make sure we are not actually break-evening our trades too fast, or we will end up losing out on quite a lot of opportunities to little spikes like this. So in this instance then, the right time to move your stop loss to break even, it varies on every trade, okay? It is a bit of an argument. When is the right time to break even your trades? Now, personally, I'm looking for structure lows to give way, right? So we'd be looking for a structure low point to give way, which would be like one of these. But because this is so far into profit, what we could actually do is await some form of consolidation. Now, this here strikes my interest, okay? You can see the market moving sideways. In this instance, I wouldn't yet move it. We do have, of course, the smaller supply zone formed. So if price runs back up to here, I won't be too stressed right now. And chances are we will just get a like wick reversal before our profit targets are fulfilled. So instead, I'd be quite interested in seeing which way the market's going to move. If we're going to break beneath this, then that has formed a structure point, okay? And an area that's going to act as resistance. So at this point, I would then be happy to move my stop loss to break even. So seeing these closures, right, like that, I'll then be thinking, okay, now it is time to remove the risk from this movement. If we do that, then we can allow the market to follow this structure. And if it does decide to reverse past this point, that's going to show that there's buying pressure waiting underneath this area, okay? And that is going to invalidate this area and actually get us closed out of our trade at break even rather than at a loss. So allowing the market to play out then, when we get that big sharp movement to the upside, we will actually remain safe, okay? So that is how you are going to manage trades, by moving your stop loss to break even. Now, an even upgraded version of that, an even better thing you can do with your stop losses is move them into profit. So we can put our stop loss anywhere we want, really. Okay, anywhere above or below price, depending on which way we're trading in. And that means we can actually put our stop loss into profitable territory, so that if our stop loss is hit, we are closed out with a profit. Now, this is obviously favorable because it means your trade is either going to win, run all the way to target, and secure a large profit, or if it doesn't do that, it's just going to get stopped out at a slightly smaller profit, and you'll still come out the market with money. So it's a win-win scenario. So in this instance then, I'd be looking at the structure, and that is generally how I'm going to be moving my stop loss deeper into profit. I'll watch market structure, I'll watch for these structure points to form, and when they give way, that is when we'll actually go ahead and move our stop loss. So in this example, we saw structure point 1 giving way was our cue to move our stop loss to break even. Okay, so if price does actually trade this high up again, it's not a trade we want to be in. We've seen structure form and break. So from here, we are really focusing on the downside. Now, what we actually saw then was structure point 2 form, this one here. And then this actually gapped, the market gapped down beneath that level. Now that break beneath that level could then be the cue to move your stop loss further down, right? That is one structure point broken, retested, two structure points broken and retested. So at that point, then you could actually go ahead and move your stop loss down above the first structure point. So this way we have leeway for the trade to move, but if it does go and take out both these structure points, we can then assume that at least short to mid-term, we are trading back to the upside, and we don't want to be holding risk on that movement. So let's just put our stop above that structure point then and allow the market to run. And as we know, bam, wow, we instantly stopped out. But there we go. We would have been closed out right there, okay? And what that would secure is a very small, modest movement, 0.7 risk reward. So if you were risking your $100, you'd have been closed out here with a $70 win, right? And essentially what that means is rather than losing $100 on this movement, you've actually just secured $70. And now $70 isn't the best in terms of our overall risk reward strategy. We're always looking for more than that, more than 0.7 risk reward on every move. But for a worst case scenario, what's better? Losing $100 or making 70? Okay? So you can see the logic there. It's really not all too difficult. Structure points is what we really want to look for, waiting for structure to give way, waiting for new structure points to form, breaks, retests, things like this. They're going to dictate where and when we move our stop losses into profit or into break even. So I know a lot of traders will actually be very aggressive and fast reacting with their stop loss positioning to the point that once we get this first break downwards, they'll actually move their stop loss to break even. And this is fine. If you want to do that, you can do that. You will miss more opportunities. Okay, you will miss more opportunities where we get these wick spikes taking us out of trades prematurely before the big drops. Or on the contrary, we may get these opportunities, say you bought here with your stop loss at break even, where we get these spikes taking us out before the actual move occurs. So you're going to get more opportunities like that. Unfortunately, you will, miss out on some nice trades, but in the end, you will be protecting your capital, okay? And protecting your capital is number one. We're here to make money, but we need to hold on to our own before we can do that. So if you feel a little bit more risk averse and you prefer to actually risk-free the movements as soon as possible, you don't mind missing a few opportunities for that added comfort and added confidence that you are not going to be losing, then do that. You can do that, okay? In many opportunities, that's going to work just fine. But it's all up to you. That is my personal methodology, focusing on structure points. And I like to follow the trend down in steps. Okay, when we get a structure point form and break, that is then going to be my stop loss to break even. When we get a second structure point form and break, that is when we're going to pull that stop loss down above structure point number one to allow the market leeway. But then if we see two structure points give way, of course, the market is no longer going to be bearish or bullish, depending which way you're trading, is it? So happy to get out right there with a nice little bit of profit. And as you see, that $70 profit on that final movement would have saved us from this huge spike to the upside and a $100 or 2%, 1%, whatever, loss. So that's how we're going to be using and utilizing stop losses to remove risk from movements and then to secure profits and make sure that we won't be taking losses on these movements. Okay. So hopefully you found some good value here. Thank you for watching this video, and I'll see you over in the next one when we're actually going to talk about psychology and bringing psychology into technical analysis, risk management, and all the other aspects of trading combined.